Welcome back to Money Discourse. I know it's been another long hiatus from us, but yeah, we're back and we're kicking. So let's start this off. Coming up, higher than expected retail sales, CPI and PPI. The Walmart CEO is seeing disinflation and earnings season is over. So how has macro affected things? Rajan, why don't you take it away?
Yeah, well, I mean, this market, first of all, keeps on surprising in terms of everybody was calling for a recession for so long, weren't they? But we got higher than expected retail sales. The consumer just in general was pretty strong. And then we've just had earnings season, like you just said, that just pretty much finished. We had the tail end of earnings season, normally all the retailers and the retailers in general are saying the same type of thing, that the consumer is soft. And the biggest area where they're soft is consumer discretionary. So that's where you saw like this Foot Locker getting absolutely killed. It was down like 30%. You had Dick's Sporting Goods. You had a lot of those ones really being affected, but the ones which has the food component, they did really well. And food inflation isn't going down as quick as discretionary, especially, but there is deflation happening. But we saw this latest CPI print, which was slightly higher than expected. But considering that every reading has come below expectations pretty much for the last year almost, I'm not surprised to see the first uptick. And we see where oil is now. It's at $93. We had all the airlines come out and they just cut their guidance this week. American Airlines, United Airlines, Delta, and a large part of that cut has been the fuel price. So it's pretty much fuel was, oil was it Gulf oil has rallied about 30 to 40% for the end of the last quarter. So we've seen a lot about 10, 15, 20% rises in the forecast for the average fuel price per gallon. So just in general now, this is where it's going to get interesting. We're starting to see, these costs like fuel going back up again. Food inflation isn't down as much as we want, but it's still going down. The consumer is still, the biggest thing is that everyone still seems to have a job. And so while everyone's still got a job, the bills can be paid. And you're seeing these strikes by, like the UAW union just got announced that they're doing a multilateral strike against Stellantis, Ford, and GM, a limited basis. But it seems like these guys have all got the power right now. We saw UPS, they, the average UPS driver is going to make 170 odd grand, which is crazy. Who needs to go to college? You can just be a UPS driver, 170K. There you go, right? And then, now you've got the same thing for, I don't know what they're calling for, but you had the pilots union, they're getting a big contract. So it seems like a lot of these companies, they're trying to get labor is a lot of the challenges right now, trying to get labor. So they seem to be in charge. And that's the environment we're in right now.
Yeah. I mean, yesterday, if you saw retail sales stronger than expected, CPI and PPI stronger than expected, and Europe is afraid of inflation, right? And normally, well, especially like looking at the market in the last year or so, normally kind of tank because there's that uncertainty on what's going to happen now. I think now the market's potentially priced in what's going to happen. They've got a clear trajectory on that we've already maybe hit the terminal rate. And what does that signal to you? Do you think it's like now time to kind of go gung ho, or is it just
well, I think the Fed has always said around this time. I mean, I can't really see any real benefit to raising rates more than where we are now. We're in the 5%, and I think every rate hike right now would just be incremental. Like I just cannot see what the point is of raising it. And I think the Fed is saying all of this stuff to just keep the market on its toes, but I don't really see any real reason why they would need to do it, because you see headline inflation is in the 3% range. So, we're not at these crazy 8, 9, 10% levels. Core inflation is still a bit strong, but remember there's a lag effect. And I think these guys well and truly know all of this. So, maybe you might get a 25 basis point hike, but I can't really see it. The ECB, they done a rate hike yesterday. It was up to 4%. Bear in mind, how long was ECB at like negative 75 basis points or 50? So, I mean, it's crazy how long it's happened. Now, the real question is how long they're going to keep it here. And then, I guess the market just adapts to the new rates and what it is. But
100%, yeah. And it's really interesting. The Walmart CEO is saying that, merchandise pricing are lower than they were a year ago, but don't hold your breath on declines in kind of food and groceries. There's deflation compared to last year, but prices are higher than pre-COVID. People who are expecting prices to come down to that level, grocery prices in general have not ever gone down over the last 75 years. So we're always going to see this kind of steady rate upwards. It's just the rate at which it increases. We were really hit quite bad over the last couple of years with inflation, but now it's calming down. The Walmart CEO says that he feels like because of inflation, it was going to actually be a tougher year, but because of employment, generally wages, and some disinflation that he's seeing, things are kind of hanging in there. So when you look at the 12-month core goods CPI, we're at the levels that we were at pre-COVID, right? And now we're going to kind of see the housing inflation, because it's severely lagged, start coming down as well. And so that's all ahead of us. And maybe that's another reason why it's kind of priced in. What are your thoughts on that?
Yeah, no, I mean, like what the Walmart CEO first of all said is so true. I mean, if you look at bread prices, well, over here it's like $4 plus for bread. It used to be like $2.50, $3 not that long ago. But milk and eggs is definitely coming down. But yeah, I mean, it remember what we were saying before, like when we see inflation at 2%, that only means it's rising 2% from last year's 10%. So it's not like you're going to get it down to what it was. It's not like when inflation is 2%, you're going to get a retraction to the mean. We need deflation to get the prices back to any type of norm that we used to have prior. And again, I don't really see that. And I think the supermarkets have been very slow at reducing those prices. But
if the consumer is actually generally weak, right, and but they can potentially still hold these kind of higher margins slightly, it can kind of offset things potentially. I'm not sure.
Yeah, I mean, you know what, Kroger. So Kroger reported, I think earlier this week, or was it end of last week? But they were saying that in their so Kroger is a big supermarket chain. I think it's like more in other parts of America, not really here in the Northeast. But they were saying that the consumers now sort of in two different categories. You've got the lower end or lower income consumer, which their baskets are now tended to be smaller, and the average price is lower. There is much more supermarket brand names. They're not buying premium brands. But then you've got the higher end consumer, which has bigger baskets, which are buying much more premium brands. So it's just really like the people that are well off right now, they're just really benefiting, spending like they don't care. And it's really a tale of two economies right now. And that's what they're observing. So it's like where, it's like, yeah, I feel like it's just that balance of how do you get it in the middle to sort of appease both ends of the spectrum. So
yeah, what's your thoughts? I mean, the University of Michigan's inflation expectations came in way below expectations, and we're kind of at the levels of 2021, right?
Yeah, I mean, if you look at it, I think everyone now, it's, they're not seeing all the news about inflation, this and that, that head. So, and I think you can clearly see that things have leveled off. So people are not seeing this continued rise that it was. So like, that's not sort of surprising. And that's why, again, I don't think the Fed has any real need to raise rates, or any of the central banks really. I think they've got it to this level where historically in modern times where it should be. But I mean, we look at the S&P, and this is that big AI fueled run up that we had, and then we had that correction, and now we're just hovering sideways. Another down move today, and again we're just trading that for. I mean, we're still up way up from the lows that we saw back in March. We were at like 3,600 or something like that. Well, no, just above 3,800. So we're still about a good 15% above that, but. I mean, you look at the market, and I think the market is now just waiting for some type of catalyst. Yeah, and we were talking about this before. Before it was bad news was bad news, and good news was sort of bad news, and now it's more like bad news. As soon as we start seeing more recessionary prints, it's sort of more. The market is reacting a bit more positively, right? And we're back to that level, but it's not the same extent to what we've had in the past, where a bad non-farm payroll would jack the market up. But it sort of just lends credence to the idea that the Fed is pretty much going to stop here and now. Like, the real question now is, when are they going to cut, if they're going to cut? Now, before the market had that they were going to cut this year, everybody thought they were going to cut by the end of this year. But you remember, I just said, why would they cut? Because everybody was pricing in this recession that hasn't really come in. So now I'm guessing, I haven't actually looked at the yield curve, but I'm guessing it's getting a bit more flatter. as this idea of recession isn't really coming to fruit, especially when you see numbers like that retail sales number and things like that. So, I mean, right now I think we're going to be more earnings dictated now, seeing where all the companies are going. And I mean, if you looked at this earnings season in general, I mean, if you look at most of the companies, they all pointed to some kind of macro headwind as the risk. But in general, they saw strong growth, and they saw, like Adobe yesterday, they reported and they had another 12% growth in the quarter. And it's like, it seems like, the money's all there. It's all swashbuckling around everywhere. And Adobe is down 4%, which also brings us into the next segment. It's about this AI. So, but the last time we had a pod, that was before NVIDIA reported results, and they are the benchmark of the AI movement. NVIDIA actually, they had blowout numbers. I remember we had that incredible guidance that they had $4 billion above expectations, and then they reported results $2 billion above that. So their initial Q2 guidance or Q3 guidance was $7 billion. They ended up reporting $13 billion in that quarter, and then the next quarter is $16 billion, which is, I mean, it's just incredible, like the numbers they're putting up. But this is the thing: the stock went initially up to like 5, and then where is it now? About 440. So the thing is, it's like, it just shows, it's just that the market already priced in this mega growth. And so if we look at NVIDIA, just breaking it down, we had revenue of 13.5 billion, which beat the estimate by 11.2 billion. And again, it was all data center driven, right? So you see that data center growth was up 140% quarter on quarter and up 170% year on year. And when you look at all the other segments, gaming was roughly in line, Provix a little bit ahead, and auto and robotics were a little bit light, but then the EPS was strong. And then you look at that look at those gross margins, 71.2%. That's up from 46% last year. So they're just killing it. But everybody was saying, how sustainable is this? And it's this huge ramp up right now. And we're already seeing all these reports. And I don't know if you've been seeing it as well, where like the use of ChatGPT is starting to level off. And, the whole massive up curve, that we're getting, it's all just sort of leveling off. And even with Adobe, that was an AI play, their initial move. And although the underlying business is doing well, their AI segment hasn't really come to fruition yet. And they're saying next year, maybe we might see some tailwinds from AI, but it's not really happening. C3 AI, wasn't anything to write home about. But again, it's this NVIDIA H100 AI infrastructures, seeing massive demand. They also announced a $25 billion buyback. And then their guidance for next quarter, like at the midpoint, 16 billion, which is above the 12.8 billion and well above the highest estimate. And their gross margin, their OPEX, so they're getting lower OPEX and then higher revenue. Just right now, it just seems like NVIDIA is just in a league of their own, And then so I was looking at the analyst comments, from all the following the results, and so some of them were saying they're positive on strong supply momentum, which is essential to meeting the exponential demand. Seeing data center growth across all three centers. China demand still making up for 20 to 25% of sales. So that's a potential risk. So if this chip ban happens, still a big chunk of NVIDIA sales are coming from China. So that's a potential headwind. Then you've got gaming revenue was pretty good, and optimism over demand visibility over the next year is still pretty good as well. So, they're seeing demand for the next year still right there in their track. But again, it's how much can this be sustained? That is the real question. So
yeah, 100%. I find it interesting announcing a $25 billion buyback, but in the last few days, the NVIDIA CEO has sold $100 million worth of stock, right? So this is his third sell today. And it just reminds me of November of 2021, where all these CEOs were just getting out. So maybe Jensen actually understands that potentially this might be the peak in terms of valuation, because they were talking about in the All In podcast, that essentially these GPUs, they kind of get commoditized, and then it's all about the system. What they were saying that was quite interesting is that before, you used to care about if you had an Intel Xeon processor running, on your hardware or whatever it was. And then as soon as AWS comes out, it's just about what's my EC2 instance and how much does it cost me for compute for a certain amount of time. And then that's exactly what's going to eventually happen with NVIDIA. And, there's the potential Tesla side of it in terms of like competition. But essentially, like Meta did, they open sourced the kind of playbook for data centers and how to structure things. And potentially that might happen on the GPU side. But for now, nothing can touch NVIDIA. So maybe Jensen's looking down the road and thinking, okay, let me just get...
Well, you know what it is? All the top despite how much you believe in the company, when all of a sudden you just see the net worth go up 3 times, like it's just prudent to take some money off the table. At the end of the day, you can believe in the company
stock
all you want.
Yeah, he's selling stock. But then Nvidia is buying it, so it's like he's selling it to Nvidia. Maybe, I don't know.
There you go.
So,
he's selling it right back to Nvidia.
Yeah.
But yeah, it's pretty crazy. And to be honest, if I was still in Nvidia, I would have been selling all the way up right now. I guess looking ahead, like what have you been? Have you been pretty active in the market right now? You've been more on the sidelines. What's been generally your stance right now?
Yeah, I've actually got like very small amount of positions on the option front compared to what I normally have. I'm not sure what's going to happen, and like the Fed's warning of a specific scenario that could derail the market, but I don't think anything like that's going to happen. But you're seeing in terms of like say Tesla and Nvidia, right? Morgan Stanley bought like 5.8 million shares of Tesla and like 6.2 million shares of Nvidia before like doing their price target upgrades, which has kind of pushed the stocks up. But obviously Nvidia's down today. It just seems like when big money comes into it and they can push these stocks around, but they can easily just liquidate as well. So I'm just happy with my longs that I've got at the moment. They're doing all right. What about you? What have you got in terms of positions?
Yeah. Well, I mean, anyone who's following the average trader portfolio, you can see that I've got a very small amount of positions. The thing is, especially on the option front, it's just the risk to reward is so low when volatility is where it is right now. It's like what it is. It seems safe. It just seems like nothing's happening, and before you know it, bang. So, and the thing is that it's just not. So my actual level of positioning right now is very low. But we have seen a lot of these stocks that have been absolutely hammered, especially in retail and with Nike below 100. Seen Target low 120s, so we've just seen a lot of that. And so I nabbed a little bit of a Nike as well. Coinbase has been just the best play for me over this whole year because it's just so volatile, but the thing is that it's volatile in a range right now, but I'm back at that level where I'm short in energy again. So I took a bearish position in ExxonMobil was at 117 on the back of this oil move. Because like I said earlier with the airlines, oil is at like $93, $94 a barrel. So we're back right up there. It wasn't that long ago, we're below 70 and we're back at 90 something. So again, so just naturally, when things seem to be a bit stretching, I think Exxon hasn't got this high in a long time. So let's just see it. Got in front of it. Let's see how it goes. One of my worst plays, people following Twitter will probably know, just Carvana. And I got my ass handed to me, and I just stayed away from that now. I was debating whether to put in another shortest position on when it was at 50, and then it went up to 55. It's gone up 10, 11%. Again, with Carvana, I just don't get it. They are making $5,000, $6,000, $7,000 gross profit per car. Who the hell is selling to Carvana and then buying it at a $6-7 markup? It just their offers compared to everyone else is so bad. I just don't know who's selling it to them, and then who's buying it. Because there's so many good deals to have out there. I don't understand why you would buy a Carvana. But anyway, it's But but that's that's just pretty much just what right now. Just like you, just keeping it and just waiting for that big move one way or the other. And then just taking it from there. Like I said, I've got some longs on Arm IPO yesterday. I managed to get a small handful of shares in the IPO. So let's just see how that works out. But again, it's overpriced.
But there's such slim pickings with IPOs at the moment, and that whole time from like 2020 to beginning of 22 was just so insane with all the SPACs and all the excitement and all the money and just like throwing it in, and you'll be up there in a day.
How many of these stocks, like you look at, I remember Virgin Galactic was at 60, 70. Now it's like 2. The amount of stocks that you look back and you go, why the hell didn't I sell with my eyes closed, everything? But Lucid is at 6, 7. I don't even know where it's like 5. And it was at 70 odd at one point. There was so many just
With
insane.
Richard Branson sold, I think, $1.4 billion of Virgin Galactic stock,
Smart.
right? Yeah,
Chamath
he was smart. He
sold.
knew this is the
Shit.
thing, right? Like
Yeah.
when you know that there's no S curves that these things are riding, not profitable, you just get out while the timing is good, or at least exit enough of your position. So, especially if you're up to just pay for your stock and just let the rest ride. But again, greed just gets in the way. You're seeing all these guys with 100% P&Ls just in a day, and you just kind
Yeah,
of
all them
think,
Twitter
oh,
gurus, they've started to like, I don't see them as much no more. Like all of a sudden these 18, 19-year-old gurus that are running all of these chat rooms that doing it while in a university lecturing room, but still, but to be honest, fair play to them. They rode it while they could. That works when the market is volatile, but when you've got a drab market like this, it's hard to be some type of signal giver.
yeah.
Because
I still remember there's one kid that made a decent amount with Tesla, and then he's like the new thing, tattooed chef. You look at that. I think I got a notification because I had this small amount of tattooed chef shares, and it's like, oh, this is delisted now from our exchange, meaning it just doesn't have
yeah,
enough of a market
probably
cap to
like
be
what
within
is
trading.
what is TTCF now?
It's like 4 cents.
No. To be honest, I still see them around. Oh my god, yes, you're right. 4 cents. That used to be at a peak $28. It is worth 3.6 million bucks. It's pretty much
Yeah.
just done. That's crazy. But
Jeremy
yeah,
out.
get help Jeremy out. Is he still in? I wonder.
I don't know.
Yeah.
Oh gosh. Yeah, I'll tell you. You know what? This exuberance is going to happen again. I'm sure, but it's still going to be.
How much do we learn from it?
Yeah.
The thing is that in the exuberance, you never know the best time to sell, and you'll never catch the top. But the thing is that you sort of know when everything's going up in hot air. At one point, your sale will be an amazing sale, even if you miss out on 70% or 100%, because you just don't know where that top's going to be.
Yeah. 100%.
But But on that note, we'll just call it for this one. And I mean, looking forward now, I mean, there's not really that many catalysts going on until the next earnings season. So let's just see how the macro plays out and see what the central banks do. We've already seen the ECB this week and the Fed next week and stuff. So we'll see how it all works out.
Yeah. So we'll see you in the next one. Thanks.
Catch you in the next one.